What if I told you the most successful investor in modern history wasn't a Wall Street legend, wasn't a TV personality, and didn't even believe in stock tips? No shouting on trading floors, no breaking news interviews, no flashy predictions. Instead, a quiet mathematician used equations, patterns, and data to do what no human trader ever could. He didn't predict the market, he measured it. Over 30 years, his strategy generated returns so consistent, so precise, that even today, many people don't believe the numbers. His name was Jim Simons, and this is the story of how pure mathematics quietly conquered Wall Street. Why this story matters. Wall Street stories usually follow one of two paths. Either a bold risk-taker beats the odds, or a genius makes one lucky decision. But this story is different, because Jim Simons didn't rely on intuition, market opinions, insider knowledge, or economic forecasts. Instead, he asked a dangerous question. What if markets are not emotional, but mathematical? That question changed finance forever, and today, your pension funds, your retirement plans, and even your index funds still live in the shadow of his ideas. Jim Simons wasn't born into finance. He was born into numbers. As a teenager, he solved advanced math problems for fun. By his early 20s, he was working as a code breaker during the Cold War, using mathematics to analyze encrypted signals. No headlines, no recognition, just logic, silence, and discipline. Later, he became one of the world's top mathematicians, publishing groundbreaking work that other mathematicians still study today. At one point, he was so respected that some believed he would spend his entire life in academic mathematics. Wall Street was never part of the plan, but curiosity has a habit of crossing boundaries. In the late 1970s, Simons became fascinated by one question. Why do prices move the way they do? Not why should they move, but why they actually move. Instead of reading financial news, he studied historical price data, volume patterns, statistical irregularities. What he saw shocked him. Markets weren't random. They were noisy, but noise still has structure. Tiny signals existed, short-lived, invisible to humans, but detectable by machines. That realization led to something radical. Jim Simons didn't hire traders. He hired mathematicians, physicists, statisticians, cryptographers, people who had never traded a stock, people who didn't care about earnings calls or breaking news. He built a research lab, not a hedge fund. Their mission was simple, but bold. Find repeatable patterns in market behavior, then let computers trade them automatically. No emotions, no opinions, no ego, just probabilities. Most people thought this would fail. Markets were too complex, they said, too human. They were wrong. The early years were brutal. Models failed. Signals disappeared. Losses happened. But Simons believed in one rule. If the math is right, short-term losses don't matter. The team refined their models. They tested relentlessly, discarded weak signals, combined thousands of tiny edges. Each trade meant almost nothing, but together, they formed a machine that traded thousands of times per day across multiple markets without hesitation. This wasn't gambling. It was engineering. Then something unprecedented happened. Year after year, the system worked. Not occasionally, not during bull markets only. It worked consistently, even during market crashes, even during global uncertainty. The returns were so strong that eventually Simons did something unheard of. He closed the fund to outside investors. Why? Because too much money would break the system. That's how precise it was. Most investors try to be right. Jim Simons tried to be less wrong more often. His system didn't aim for big predictions. It aimed for small advantages, repeated thousands of times, with strict risk control. Losses were expected. They were measured. They were contained. The real edge was discipline. And discipline doesn't get tired. Jim Simons never became a media figure. He avoided attention, avoided predictions, avoided debates, but his influence spread silently. Today, algorithmic trading dominates markets. Data science drives finance. Machine-based decision-making is standard. He didn't just win the game. He changed how the game is played. What makes Jim Simons truly different is not just that he succeeded, but what happened after. Because once his approach worked, Wall Street didn't argue with it. They copied it. Slowly, at first, then all at once. Banks began hiring physicists instead of traders. Hedge funds started recruiting data scientists instead of economists. Trading floors grew quieter, while server rooms grew louder. Decisions once made by gut feeling were now made by probability. The market didn't look the same anymore. Lessons for everyone. This story isn't about money. It's about thinking differently. Jim Simons proved intelligence matters more than opinions. Systems outperform emotions. Consistency beats brilliance. You don't need to predict the future. You need to prepare for uncertainty. That idea applies far beyond finance. Jim Simons once said, "Nothing dramatic, no bold quotes, no motivational slogans, because his work spoke for him. While others chased headlines, he chased patterns. While others trusted instincts, he trusted evidence. And in silence, numbers rewrote financial history." The market was never conquered by force. It was solved quietly. Sometimes the most powerful revolutions happen without noise. If this story made you think differently about markets, intelligence, or discipline, take a moment to like the video. It helps this story reach others who value depth over noise. If you enjoy long-form documentary-style stories about finance, history, and ideas that quietly changed the world,